Williams Sonoma Stock, ticker symbol WSM. I recently bought this stock because of several reasons. The stock is up almost 10% year to date, slightly underperforming the S&P 500, which is up 14%. From a dividend point of view, things look pretty interesting with dividend yield at 2.85% and also 16 years of dividend growth. On the 23rd of May, Williams Sonoma presented quarter results where they beat on EPS but missed on revenue by a small margin. For the upcoming earnings, analysts have a mixed feeling. So does this mean that WSM stock is a buy at current prices? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Williams Sonoma do? Williams Sonoma is a multi-channel specialty retailer of high-quality products for kitchen and home and living. Williams Sonoma has several brands under its wings. If we dive in the most recent earnings report, we see that net revenue was reported at 1.75 billion, down from 1.89 billion last year, which is of course something that I don't like. Cost of goods sold is up to 61.5%, while last year it was sitting at 56.2%, which is also something that I don't like. This lowers the gross profit with roughly 5%. Operating income was reported at 11.4% versus 17% last year. EPS was reported at 2.38 versus 3.59 last year. And if we dive into the different brand performance, we see that Pottery Barn is by far the biggest brand, representing roughly 44% of the total revenue. This brand has no comparable brand revenue growth, which concerns me a little bit. But keep in mind, it's a different time right now versus last year due to different reasons. West Elm, which is the second largest brand, representing almost 26% of the revenue, sees a decline of almost 16% in comparable growth. The other brands are also reporting a decline in comparable revenue, so that's definitely something to keep your eye on. Williams Sonoma reiterates its 2023 full-year outlook with revenue growth in a range of -3 to 3%, with operating margin between 14 and 15%. Long term, they expect mid to high single-digit annual net revenue growth, with operating margin above 15%. So this is definitely something to keep your eye on. 2023 will be a tough year, but long term they will do fine in my opinion. If we dive in the most recent earnings presentation, we see some interesting things as well. 66% of the revenue is coming from the e-commerce channel, while only 34% is coming from the retail brick and mortar channels. Another thing is the ROIC, which is reported at almost 50%, which is an insane number of course. Average annual total return to shareholders also looks pretty decent, both short term and long term. Another thing that I really like about this business is the fact that they have 150 designers and artists in-house, which led to a 90% proprietary products designed and made exclusively by their own brands, typically lead to higher profit margins. And their brands are matching almost every corner of the price point aesthetic combination, which is also something that I really like. And if we go back to the e-commerce channel, we see that e-commerce revenue is growing at 16.6% compound annual growth rate, which is of course a very good number. And Williams Sonoma is the #1 e-commerce home furnishing retailer. The last thing that I want to highlight from this presentation is the profit margin. Pre-COVID it was hovering around 8.5%. And during COVID, when stores were closed and most of the sales happened online at higher margins, the profit margin was sitting at 17%. The current profit margin is hovering around 14 to 15%, which is a great margin compared to the pre-COVID levels. So to me, this looks really good. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Williams Sonoma is an 8.2 billion market cap company. PE ratio is at 8, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for WSM Stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 8.5 billion and in this graph we see that revenue went up really nice and steady. During the lockdown periods revenue skyrocketed and most recently revenue started to slow down, which is of course something to keep your eye on. Over a longer period of time margins are going up, which is something that I really like. And yes, we see a decrease since 2022, but this is lockdown related and the current profit margin is looking really good to me. EPS is going up really nice and steady and is also down in the most recent quarter, so this is looking similar with the previous story told. Analysts have mixed feelings about the coming years, with ups and downs being very big. In 2023 it's expected that Williams Sonoma sees a 15% increase in EPS, while in 2024 it's expected to see a minus 16% in EPS. In the following years it's sitting at an average of 10%. For the revenue it's pretty much the same story but with lower numbers. We see an average of mid-single digits, which is very nice. Return on assets is sitting at 18%, which is a great number, and it's the same story with the return on equity. It's looking rock solid. And the most important number, return on invested capital, is sitting at 34%, which is a really good number, especially since it's higher than the 5-year average of 27%. Current ratio is at 1.12, which looks pretty good to me. Over a longer period of time it's decreasing, and I would prefer a range of 1 to 2 here, so it shouldn't decrease any further from here. Total debt is sitting at 1.4 billion, and I prefer companies that can pay down at least a third of the total debt with the current cash position. Right now total cash is sitting at roughly 300 million, so they can't pay down a big chunk of their debt, which is something that I don't like. But to be honest, it doesn't worry me that much because of the free cash flow. To me it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up quite nice and steady over a longer period of time. A thing that I love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2.85%, which is a great number. Annual payout is at $3.6 and payout ratio is at only 20%. I prefer 50% or lower, so right now they have roughly 80% left in cash to buy back shares, pay down debt, acquisitions, research and all other things. The 5-year growth rate is at 15%, which is a great number. On top of that they grew the dividends for 16 years in a row, which is also pretty impressive. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that over a longer period of time payout ratio is always below 40%, which is really nice. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at historical numbers, which is very nice. And overall the dividends look pretty good to me, but how about the historical returns? I decided to compare Williams Sonoma stock with the overall market, in this case the S&P 500. Next to that I added some competitors, Wayfair and RH. On the 5-year chart we see that WSM had a 131% return including dividends, and crushing the S&P 500 and competitors by a big margin. On the 1-year chart it looks pretty different. WSM had an 8% return while the S&P 500 and both competitors are seeing a 16 to 27% return. On the 6-month chart it's pretty much the same story, with Williams Sonoma returning 10%, while the S&P 500 returned 17% and Wayfair returned 99%. On the 1-month chart it's again Williams Sonoma with a 10% return beating the S&P 500. But both competitors have seen a higher return with 25 and 71%. So bottom line, Williams Sonoma beats the S&P 500 in the long run and most recently started to outperform the S&P 500 again. But does this mean that WSM stock is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 2%, 4% and 6%, since I think they will increase the revenue at lower numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. For the profit margin I'm filling in 11, 12 and 13%, based on their own current outlook and current performance. For the free cash flow margin I'm filling in 9, 10 and 11%. For the PE ratio and the price to free cash flow I'm filling in 10. It's a big company with great fundamentals and there is still some growth left. However, I don't want to overpay for the growth. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, WSM stock is at $125. I hit analyze and we see a lot of green numbers. We have a low price target of $108 to $133, which is around the current valuation. We have a mid-price target of $137 to $165, and we have a high price target of $172 to $204. To me, the mid-price target is the most justified here. I think this company will come back very strong in the coming quarters and years, and return to outperform their industry and also the S&P 500 in terms of returns. My final conclusion on this stock is that I really like the business. They have a great business model with 90% own brands, leading to higher profit margins. Next to that, management is doing a great job growing slow but steady. The stock has great fundamentals and still some growth left, and from a dividend point of view, things look pretty good either. I recently opened a position in this stock and I'm planning to buy more shares throughout the year at current prices. To me it looks undervalued with the price target of $137 to $165. In the meantime I'm collecting dividends and I will analyze this company every now and then. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that it brings some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my new video.